Well, good morning, good afternoon, or good evening, ladies and gentlemen. Welcome or welcome back to Deloitte's live webcast series. My name is Dalibor Petrovic. I'm a partner at Deloitte. Over the last number of years, I've had the pleasure to host this series of live conversations that we have been producing primarily for technology enthusiasts, technology leadership, technology leader audiences. In this series, we are exploring a variety of topics that we feel are really critical and timely, specifically for those executives who are responsible to fund technology and govern technology, but also those technology leaders and technology executives who are tasked with creating value for their organizations. Today, we have a special topic. We are going to talk about access to capital, specifically in Canada, and the whole concept of venture capital, the industry, the ecosystem. What are some perspectives and advice that we could provide to the Canadian technology entrepreneurs and visionaries who are looking to have easier, better access to funding? And who better to tell us that story than our Deloitte Ventures dream team? I am very thrilled to welcome Jay Crone, who is the Managing Director of Deloitte Ventures. Thank you very much, Jay, for finding the time to be with us this morning. And also, I'm going to welcome Jonathan Wolken, a colleague and peer of Jay's, also Managing Director of Deloitte Ventures. So with that, this will be an interesting topic to cover. Ladies and gentlemen in the audience, this is a live conversation. So if you have any questions that you would like to ask, please use the Q&A function of our Zoom platform, and we will do our best to cover as many questions as we can over the remainder 50 few minutes that we have left. So with that, maybe we start with sort of the biggest of questions, or sort of the bird's eye view here. Maybe Jay, if you can just maybe briefly actually introduce yourself and then help us understand sort of what Deloitte Ventures is and how it fits into the rest of the VC ecosystem in Canada.
Great, yeah, happy to do that. And first of all, thanks for having me, Dalibor. I really like what you've done with this podcast series. Yeah, so in terms of my background, I started my career in investment banking and M&A at Scotiabank in Toronto. I did that for a number of years, left and took the entrepreneurial route and started a company, which I built into an online course business. And then switched back into working for someone else and joined Hootsuite. In the meantime, I moved to Toronto. I worked for Hootsuite, a social media and analytics company, working in their business and corporate development group. And then ultimately started my career in the venture space, joining TELUS Ventures. Got to be a part of the TELUS Ventures journey as they kind of significantly scaled up their operations and kind of learn the ins and outs of the corporate venture game, and joined Deloitte Ventures shortly after the launch in 2022, and have been sort of on the Deloitte Ventures ride for the last 2 years or so. In terms of Deloitte Ventures and our vision and what we're trying to accomplish, I think the first thing I can say is the idea of Deloitte and Deloitte Canada in particular being well positioned to succeed as a corporate venture capital group has been around for a very long time. So it's not a new idea, but it's a complicated thing to get off the ground and running. And I think the stars just sort of needed to align in order for the right group of people to be in the right place to push this initiative and get it done. And I think over the last couple of years, that happened. And I think the opportunity that was seen was, Deloitte has access to a lot of the sort of key building blocks that you need to be successful as a venture firm. So, I like to say that there's not that many things you actually need to do to be successful as a venture capitalist. You just there's really three. And, one of them is you need to find the right deals. The second is you need to get into those deals. And the third is you need to be a helpful enough investor after you invest the founders that you invest in say good things about you. And if you can do those three things, you're likely to be able to repeat that over and over again successfully. And I think if you think about Deloitte with 10,000 plus employees across Canada, 1,000 partners, many folks who are touching the tech ecosystem across Canada in a variety of different ways, you can see that the power to do all those things should be there. We have leaders who are interacting with founders and executives of large companies who are keen to understand the latest technologies that are out there and the up and coming new companies that are approaching new and innovative products. Those same experts can be helpful in advising and taking the products of those companies to markets should we choose to invest. And if we can do that second part well, then the founders are going to say nice things about us, because if we give them the capital they need and we can help them grow post-investment, they're going to tell the ecosystem, and we're going to make a brand for ourselves. So that's all kind of the backdrop. And then in terms of what we're trying to accomplish, I think there's kind of a few key objectives. So, one is we really see a need for additional sources of capital in Canada. It's a market we think there's opportunity for more venture funds to enter and be successful and support Canadian companies. And we really want to help be a part of spawning the next generation of Canadian tech leaders. So, the types of companies that are going to be anchor tech companies that can bring in talent and attract, new jobs and help grow the Canadian economy and establish Canada as a tech leader. That's kind of the high level objective for us. And, we also believe that we can be successful financially for Deloitte, both from getting returns on the investments themselves, as well as finding synergies between our traditional Deloitte business lines and what John and I and the rest of our team are doing in ventures. The other kind of unique thing I've mentioned for Deloitte Ventures is, or not necessarily unique, but different, is that we are a corporate venture group. And that means we bring, a slightly different lens versus a traditional institutional venture group, in that the value add we bring to the table is going to be much more related to our expertise as a partnership. So we have, partners across the country who are, have deep subject matter expertise in the markets that these companies are trying to grow into. We have access to the clients that they want to build relationships with. There's a whole variety of ways that we can leverage the sort of institutional power of Deloitte to power the growth of our portfolio companies. And that's part of what we bring to the table as a corporate VC. So hopefully it's a good primer.
So Jay, that was an excellent overview. Thank you very much. So John, I wanted to, of course, give you an opportunity to also introduce yourself, and maybe what you can do is help us understand like the landscape of Canadian capital ecosystem, if you wish. You mentioned corporate VC, who Deloitte Ventures are. What might be some other sources of access to capital, and maybe, John, reflection on what might be some pluses and minuses of those, if you could.
Yeah, thanks. And again, Jay mentioned this, but we're really excited to be here and share what we've been up to at Deloitte Ventures, but also, provide a light on what a corporate venture fund can also offer. Yeah. From a background standpoint, Jay has mentioned so much of my background already because we've worked together for so long that it's not worth getting into the details. But what I'd say is across my career, a big part of it has been supporting tech companies and accessing capital and advising them on key strategic decisions that they make as an advisor or as an investor or as a board member. So, being at Deloitte Ventures now and really starting to see a lot of the things that Jay mentioned in terms of how we work with our portfolio companies and aim to create value with them over the last 2 years has been really exciting, especially for a new program that entered the market with a strong brand behind it. The fact that we've been actually able to take some of our portfolio companies and bring them network and market access, allow them to have mentorship and support from professionals across some of our key business lines and industries like strategy or finance or on the privacy and security side, and help them solve problems more quickly. Having that access has been really excited to see. And that's one of the functions that you can get when you have a corporate venture fund on your cap table. So in the Canadian market, I think there's a range of capital sources that you can have, and also it's almost somewhat dependent on the stage of maturity of your company. But the great thing that I think every entrepreneur or management team or founder should think about is, how can I get a diversified group of skills and expertise and I would say pathways to create value within my cap table, within my customer base. And one of the things that we don't see as much in Canada, especially from a corporate standpoint, is the large enterprise organizations in many industries really dipping in and allowing these emerging technology companies, these emerging companies, to really tap into that expertise and have the opportunity to create value together. So whenever we talk to founders and when we're trying to invest in their companies, our pitch isn't, we have money. I think if companies just want our money, I don't think they're the greatest companies for us to invest in. Ultimately, and I think this is something that, when you're building a business and you're bringing investors into your business, you really want them to help you add value and help you bring yourself from, point A to point C, even in a much quicker and more efficient way. And you can get that from institutional venture capital firms who have great networks, who have great track records of picking the right types of companies and seeing companies through, the peaks and valleys of entrepreneurship, which is a trying experience. And also have networks of talent to access and place into those organizations. And I think what the corporate organizations really have is that access to the market and the access to customers. And that's something that we try and really differentiate ourselves on.
Yeah, the way you describe it makes complete sense. It's actually pretty different. And this value proposition that, when you are part of Deloitte Ventures, you have access to 15,000 Deloitte people in Canada who have expertise in all aspects that can help, not just money, and plus relationships into the market and clients. Like, that's a very powerful value proposition for sure. I would love to ask if you could maybe let us know what kind of companies are on your radar. I understand that you guys are organized by industry. So I would love if you could share with us, maybe, John, you can start. Like, what are the types of companies or types of industries that you're focused on, and types of companies you're looking for to invest, actually?
Yeah, for sure. And we really think about our fund overall, which is a $150 million fund broken down between direct investments and fund investments. So about 20% of our capital has been allocated to funds that invest in categories that we really are interested and excited about, which leads to, the direct investments, which are predominantly where we spend most of our time at the Series A or the Series B stage of the company to invest directly. So as you mentioned, Jay and I somewhat split that nationally in terms of these sectors of expertise. So I am more focused on the health tech, data and AI, and future of work tech areas. Jay's more focused on the climate and sustainability technology, cyber and fintech verticals. And really, we try and lead and build out our investment thesis along those lines. On a general basis, from a criteria standpoint, we're really trying to find great entrepreneurs, great teams that have a reason to win in these designated sectors as a starting point. And we move from there in terms of how we want to invest at the stage that we invest at. So for a Series A company, have they got to product market fit? Are they generating revenue already and have a good understanding of who their end customer is and a repeatable process to go out and acquire those customers? Another main thing that we think about too is the type of technology that is being built within the company. We have a bias towards enterprise B2B software, B2B SaaS companies, because we have a strong belief that it's a very efficient business to build from a capital standpoint. And at the same time, through the relationships that we have within our organization, we can disproportionately help those organizations scale in those end markets based on the clients that we have.
And in terms of, you mentioned for Series A companies, what you look for, you mentioned we also fund Series B companies, Series B rounds. Jay, are there any sort of general parameters that you guys use to qualify a company that would be good candidate. And by the way, I didn't forget, I do want to ask about which are these industries that you serve or you focus on in terms of the investments.
Yeah, thanks. Yeah, so I'm responsible or the leader for our investments in cybersecurity, fintech, and climate tech. And then in terms of looking at different metrics to evaluate our or screening the companies for Series A or Series B. I mean, for us, first of all, the Series A implies somewhat of a reasonable amount of establishing the product on the market and having already had sales underway. So we like to look for companies that have or are close to $1 million of recurring revenue as one kind of threshold to establish that they're in the right size bracket. And then in terms of everything else, it really does depend on sort of the sector, what the comparable deals in that particular sector look like. But there's some key metrics we're always going to be looking at. So things like what's their revenue growth been like? What types of gross margins do they have? How big or how material have they been able to grow the revenue relative to the amount of capital that they've raised to date? And the further along and more mature the company is, the more we expect there to be a little bit closer to a clear system for how to grow the company. So at Series A, you have a product in the market. You have some early traction, which suggests that you have product market fit. You're probably still kind of mastering how you actually go about that sales process. So whether it's direct sales or whether it's through digital marketing or however you're going to approach it, you're probably still experimenting. By the time you get to the Series B, you'll likely have a little bit more of a established and clear process for, we have determined that if we spend X number of dollars on our go-to-market process, we are fairly confident that we're going to end up with Y dollars of revenue. And it won't be perfect, but you'll have some more clarity on that. And you're really raising the capital to put the sort of pedal to the metal on that particular strategy. So there's a lot of other metrics and stuff that we look at, but hopefully that's a good primer for some of the high level stuff that we look at.
Yeah, absolutely. More established. So yeah, that's actually very fair. I would be curious if you could maybe share some of the success stories, like what might be some of the companies. I would love to hear from both of you. Maybe we can start with you, John. Like some concrete examples of how you've seen this work, where you've seen this work successfully. And I'd love to get you, Jay, to tell us one of your stories.
Yeah, for sure. And for context too, our portfolio is now at 7 direct investments. So we've been investing since May of 2022. We're now at 7. We announced our latest investment yesterday. And we've also invested in 5 venture funds that are headquartered here in Canada and, invest across the country. In terms of a specific example of a portfolio company, I think, we have one portfolio company in Montreal called Optable, which I think is just a great representation of how we look at backing great founders in a large market trying to solve big problems. The team is a repeat group of founders who have worked together in the past. They bootstrapped their last business, which was in the ad tech space and connected TVs, and sold that business to Samsung. So already from a pedigree standpoint, from a historical ability to demonstrate that they have strength in building a business, but at the same time have very deep domain expertise. The team, was great, and you could really see the way that they worked together and built on each other's strengths as they started to build the business. And they went on this journey after they sold their last business and left Samsung to find the next opportunity in ad tech that could really drive a material business. And there's this overarching trend tied to privacy, which is an important one for us as consumers, which is really reshaping how ad tech and how the key ways that people have been targeted and placed ads on the internet, on mobile for the last decade, 2 decades, is going to be going forward. And they identified this opportunity and, started to build technology to address it, which is effectively, a data collaboration, data clean room solution that is software that allows organizations to share data in a privacy compliant way in a clean room that enables them to match and target people effectively. And again, I'm prefacing that the importance of this is the ability to effectively target people without any privacy, without any PII being exchanged in any way. And that's an important thing when you look at the world where people have been tracked across sites, across the internet, digitally, through cookies, through personal identifiers for the last 10 to 20 years. And we were introduced to them through one of the other venture investors in the ecosystem. And really, they were at this point of inflection where they already had made a number of sales and a number of logos and customers utilizing the platform, actually using it actively to drive their decision making. And really, we're at this point where they needed additional capital to scale to address this large market opportunity, which is not just a short-term trend, but a broader secular trend with a lot of tailwinds that are going to drive this business for the next 10 years.
And I can absolutely see this is a wonderful, what a wonderful story. Great Canadian idea, great Canadian proven team. Global opportunity makes complete sense. That's a wonderful,
And I would just want to add, in terms of the types of people that they brought in from a syndicate of investment standpoint, a really good mix of people that can help them in different ways. You have a traditional venture investor. You have a number of strategics that have existing relationships and businesses that need to build into this technology, so they're effectively customers. And then you have someone like us who can make some of that market access opportunities and drive some of the eminence of how the next generation of technology in the space should look like, working hand in hand with them.
This is wonderful. I love like it feels like the venture capital in addition to the incubator, like just a genuine business incubator for these organizations. And one of my objectives professionally is to help connect Canadian technology leaders and tech ecosystem. This is such a wonderful, pragmatic way to actually help Canadian tech ecosystem. I have a question of course, this is a venture capital investment. So obviously, I'm going to assume, of course, we are taking an equity position in these companies. So Jay, any maybe commentary on that? Are there any parameters and limits on our equity position, control of the company that ought to remain with the founder, and so on and so forth? Any sort of reflections on that? And I'd love to let's highlight another great Canadian story here too.
Yeah, and in terms of our target for our equity positions, like we're trying to get stakes of up to 10% of equity in the companies. And with regards to governance, we often try to take a board observer seat as part of our investment, which usually is aligned with the amount of equity that we're taking. So, if you go beyond that, it wouldn't be uncommon to have a board seat, but we typically are looking for that, mid-single digit to up to 10% equity positions with a board seat attached to it, or a board observer seat attached to it. So that's sort of our target, and we feel like that's a good position for us that enables us to get into a company and maintain our pro rata. So often you'll get rights to purchase the same percentage of shares in future financings. So that range gives us enough to feel like we can get enough capital into the companies that do well, which is a big part of driving successful returns as a venture group. In terms of another Deloitte Ventures story of a portfolio company, one that I would flag would be our investment into OneVest. So I think this one, it kind of highlights how things can take a long time, and you can be aware of people and companies and ideas for many years before it actually leads to a deal. But one of the founders is actually someone that I went to school with more than a decade ago. And so even long before I was at Deloitte Ventures, I knew the kind of origin story Him and the two other co-founders have backgrounds in, various tech roles, as well as working for different financial institutions in Canada in relatively senior positions. They actually came together through a accelerator program that was started by some of the former Skip the Dishes founders. So another kind of interesting Canadian story or origin story for the company. And really their big insight was that, the wealth management space was very analog. And so in every way, so from the user experience, I'm sure there's many people on this call that if they have wealth products of any kind and they log into their app, they have some type of frustration for how things are shown or how easy it is to make trades or get signed up for an account, get your tax documents, whatever your need is often challenging with the legacy technology that exists today. So that was their kind of main insight, and they worked through this incubator program. They played around with a few ideas, and they originally went to market trying to build a direct-to-consumer product. So hey, we're going to build a wealth management provider from the ground, like digital first, built digital from the ground up to kind of revolutionize this industry, and we're just going to capture directly new customers. And that initial model led to kind of two profound realizations. One, it's very hard to get net new customers whenever you're selling a financial product. There's a lot of competition from some very heavy hitters who may have legacy technology but have well-established brands and a lot of capital to deploy. So that was the first insight. And the other was that the wealth managers themselves were actually very interested in this technology, and they themselves were looking to digitize, and this was a big need for them. So they actually ended up pivoting from going direct to consumer to being a B2B solution, and to establish a wealth in a box or embedded wealth solution that they could offer to other wealth managers, established wealth players in the space, as well as fintechs or even non-finance corporations. So imagine if a grocery store chain or a telco or anyone with a huge number of consumers that wanted to offer a wealth product to their end customers, they could just sort of tap into one Vest solution, and they would have all the features they would need to launch that very efficiently. So that was kind of powered their growth, and they started to find product market fit. They initially did a seed round, which was led by Luge, and Luge is a VC that is known to John and I, and we've known the people there for a long time. And they, around the time they did that seed round, they started to become well acquainted with our wealth tech team within Deloitte. And so there was opportunities to work together, already collaborations taking place. We actually tried hard to get into that seed round. That was before John and I even joined Deloitte Ventures. They were oversubscribed. It was a very competitive round to get into. We didn't get in. And then, just over a year or so later, when they came for their Series A, the relationship with our wealth tech team had improved. There was different commercial opportunities being explored. And we found a way basically we fought our way into the which was also a very competitive Series A round. But that just sort of shows the relationship building that's required, the evolution of a company over time for them to find product market fit. And we're certainly happy to get into the Series A, and now we're continuing to work with them post that financing, which was June of last year, and finding different ways to grow together.
I love the stories that you're sharing, and how actually both of these stories, how it is actually people and people's relationships and people's connections that ultimately led to the conversations, right? Which is fantastic. As everybody knows, I'm a big sort of proponent of making sure that you build a strong network of peers and colleagues, and this is another great example of that working. So what I also heard you say is that the philosophical approach to investment is that we will invest up to 10%. So we are not looking for any controlling share of the company. We are looking really to rocket fuel their growth, and then we will also ask for the observer seat at the board. That actually provides, I think, a very good context of also how much typically are we investing, right? How much are we investing? So this is excellent. Where I would like to take us next is, would you be able to maybe talk a little bit about the overall sort of good and bad of the Canadian tech startup scale-up ecosystem and their sort of opportunities and challenges as it relates to access to capital, and how this Canadian system differs from other sort of capital markets elsewhere? Who might want to take that one on? John, you want to go first?
I'm happy to. I love to talk about the ecosystem because Jay and I have been around this ecosystem for quite a while, and
well, it looks like you guys are the dream team. You are like the two peas in a pod.
We're joined at the hip, yeah,
and help create magic together as you go, right? That's fantastic.
I think one of the takeaways, like we started our careers, at Scotia and banking. There's coverage of like the tech ecosystem there, and it's such a significant step change when you think about where we were a decade and a half ago, and where the ecosystem is now. And that's built upon the successes of many great entrepreneurs, great businesses that have been built over the last decade and a half, that have led to really good outcomes for both like the team members, the founders, the investors that have been able to reinvest in our ecosystem. So I just want to start there because, it's easy to compare ecosystems at a point in time. And what we have to also remember is, when we look at the Valley and we look at some of the things that have been done in the US, you're going back decades, right? Tens of years, decades of success that have had that feedback loop of the system to reinvest and build the next generation of companies. And if you think about, the last three major changes in the Canadian technology ecosystem, from Nortel and Mitel and Newbridge to RIM to, the last cohort of like Shopify and Lightspeed, like every single time we have some of these outsized outcomes, a new cluster of companies, a new region is invigorated with innovation, which is really exciting. And we're starting to see that also in terms of the quality of the talent that's coming out of our country and the talent that's coming here because of the opportunities. We have some of the best technical research and educational institutions in the world to bring this type of talent in Canada, to cultivate this type of talent that was born here in Canada, to help seed the next generation of these businesses. Many of these people are starting, and being entrepreneurs today. Others are joining companies, whether they're Canadian or American, and getting significant experience. And what's happened over the last 3 years is you've seen this major change in terms of what's happened in the market with the pandemic, with some of the overhang from interest rates, and some of the changes that we've seen from a talent standpoint in the ecosystem, where it's a great opportunity right now to invest with many people who have unique experience looking to start new companies. And for us, that's exciting when we want to invest in the Series A. I think some of these businesses need to, start to, rise from an idea. And that is exciting for us in the context of where this ecosystem can go over the next 5 to 10 years.
And go ahead.
I just add, like, I think if you're an entrepreneur in Canada, and you're trying to figure out how to raise capital and grow your business, that you should seek out and try to meet other founders and VCs on both sides of the border, just because there are different perspectives and cultures and access. The scale of the US venture capital market is just many fold larger than what's in Canada. And I think that can be a hindrance to some Canadian founders, is if you have too much of a Canada-centric mindset. Canada's a small market in the grand scheme of things. So it's helpful to get that, to talk to founders and VCs who have a global perspective and who have seen what a global success looks like for a venture capital-backed company. Because that should be your target. And if you think that you're going to have a successful exit by focusing only on the Canadian market, that's probably, much smaller than what a VC will expect who expects that sort of global success.
Yeah, that's very, very good, very good advice. I spoke, as you know, to a number of founders in this live webcast series. We call it Canada's Got Tech Talent. And when I asked them all, what do they think about, the Canadian access to capital market, every single one of them said, we are very risk adverse as investors compared to what we experience with the Americans, the US. So that was one perspective. I'd love to get your reactions to it. The second thing that I wanted to get your reaction to it is that it feels to me that we in this country have a rather systematic problem of great ideas, great talent, exceptional education. So we create great talent, entrepreneurial spirit, people start companies, people start growing companies, and then at some point, more often than not, they either got purchased or move out of the country. I would love to ask your perspectives on what could we be doing differently and better to grow companies and keep them staying in the country.
Yeah, there's you packed a lot into that, Dalibor, but let me start, and I'll see how much of that I can address. Like I think in terms of the risk averseness of Canadian investors, I certainly hear that often, and I find it hard to argue if that's with something that you have heard from multiple founders and I have heard all the time. I think part of the driver for that is just that the Canadian market is a lot smaller. So if you think about the Canadian investors that invest at any stage, seed, Series A, Series B, growth, whatever, they all know each other, and so it's a handful of people. They're all sort of in touch with each other, and that I think that's just a reality, is that it'll typically take longer for a decision to get made, and valuations will tend to be slightly lower than what might happen in the US. So that's feedback that we get all the time, and it's something that founders and VCs should consider. And in terms of part of the second part of your question, which is like, what can we do to improve?
Yeah.
I think that the more big winners we have, the greater the ability we have to dream big and take bigger risks. So that's what I'm really excited about with Deloitte Ventures, is like, hey, we really want to power these the next unicorns and decacorns in Canada. And when you have a founder who has an exit and ends up with 500 million, $1 billion, billions of dollars in their bank account, that person can take a big risk, and they'll be in their next venture, or if they're supporting another founder who they believe in, and they have the potential to have a $50 or $100 million exit, they'll have the confidence and comfort of having that money in the bank to say, hey, don't sell now. Let's not sell now. We've got the potential to make this, 10 times bigger. Don't sell to this US company. Let's grow this for another few years and do an IPO, and let's build a Canadian champion. So there's a little bit of a chicken and an egg challenge there, but that's my stab at a couple of your questions there.
That's wonderful. Yeah, go ahead, please.
I just wanted to expand on it, because I definitely agree with the perspective that there's some risk aversion in the investor population, but I would also extend that to like the Canadian population from a more general standpoint. Like, I think we are a more polite, more reserved, more risk averse culture. Yep. And I think if we can celebrate our successes and pound our chest, and also celebrate the failures of people trying from an entrepreneurship standpoint, who took the risk to build something and change something for the better. I think as a culture, if we can continue to focus on that, like, that is one of the major differences between our ecosystem and our general culture from some of the other cultures that have these types of companies that are truly that have significant successes. Like in the Valley, you have people that have been backed multiple times and are willing to get off the ground and start again, even if they, fell flat on their face. And I think on both sides, like, I think we want to empower entrepreneurs to get back up. as a culture. We want to provide them with capital from an investment standpoint to solve big problems that we have socially, from some of the biggest issues of our time from a climate standpoint. Like there is a lot of opportunity here that even though something didn't work now today, could work tomorrow, and we should really champion those things in our ecosystem.
It's a wonderful positive message that you're sending. So in other words, failure actually is an option. How else are you going to actually make a big difference when you hit the nerve, right? And I love hearing that from yourselves, who are actually leaders who make these choices of where do we invest, right?
And it's both sides of the coin. Like I think we are more risk averse to be more aggressive potentially as a culture and go faster, but we're also much less quick to say like, this isn't working, let's stop. Everyone stop. Like, and I think it's a double-edged sword to some extent.
But I think that the underpinning message there also is we ought to be more courageous. We ought to be more ambitious. And our entrepreneurs, if we want to build companies that will stay in Canada, must think globally, think big, have a big picture vision. And obviously, I mean, I'll just mention this if it's not yet obvious. All the investments we are making are in Canadian tech companies, which by definition is access to the global market, right? Technology, right? So opportunities exist. This is very, very useful. I would love to spend some time maybe talking about that from the perspective of the entrepreneur themselves. Some sort of advice perhaps for tech entrepreneurs in the audience who are experimenting in tech ventures, experimenting with ideas that might have. What might be your advice? How should they think about, and what ought to be their sort of initial steps that would ultimately lead towards relationship with yourself, with you guys?
Yeah, I'd say, we can start with like, how you start building a business from the ground up and start with a great idea and go from there. But I also think a big part of this is too, like how people can understand how they can access capital, right?
Yeah.
So you pair this with like, I have a great idea. I think there's a problem that I'd like to solve. And really what you need to start doing, and this speaks to the product market fit aspects of things that Jay mentioned before, that I referenced before, like how do you get to a point where you can test a hypothesis with a limited amount of capital, whether you're bootstrapping it yourself or you're raising it from angels, to get to a point where you have enough market feedback to understand whether this is a good idea. You need to get out to customers. You need to get out to people who are experiencing this problem and see if there's a willingness to pay. You have to understand how large the market opportunity is to see if it's an area where you are going to attract capital. And really, what's your edge in order to win? Like you might have a great idea. There could be 20 other people who have the same idea. So what's going to give you that edge to be successful? And as you start having conversations with funders, with people who are going to help back you, and that changes over the course of your maturity in terms of people who write really small checks at the earlier stage on people just based on an idea or just based on an early prototype of technology. And those people really want to know whether like there is this large outcome, this large opportunity that you're addressing that is worth spending the time and capital to support you. And at the same time, they want to know why you're going to be successful, right? And that changes over the course of time. When we're looking in front of people and trying to understand, should we invest in them at the Series A, that conversation changes. The TAM is still a very important piece of things, but we're going to be looking deeper into the types of customers that you've attracted. Are you able to go beyond just the founder selling to their existing network in order to build the business beyond what it is from like a cluster of just close relationships? Are you able to grow revenue from your existing customers? Are they using the technology and engaging with it? And you're able to take away some of the value proposition or the return on their time or their costs to make a difference in their organizations. And that continues to evolve along the spectrum of raising capital and maturity.
The only thing I'd add is just, if you're an entrepreneur and you're thinking about getting ready to grow your business and you're trying to figure out how to do that, like one big question is just, do you have a venture backable idea? And is that what you want? Because those are two different paths. Not everyone needs to raise venture money. You don't need to raise from institutional VCs or corporate VCs in order to grow your business. You can raise money from friends and family. You can build a profitable business from day one and grow it, based on the capital that you bring into the business. And there are some big factors to consider there, because if you raise venture money, you're all of a sudden you have responsibilities to other people, and those people are going to expect that you deliver a certain amount of growth. They're going to expect you to, report to them on how things are going. You're no longer, you're still the CEO or the founder, but you've got people who are depending on you to deliver certain outcomes. And that is a different experience versus being sort of like a sole proprietor or, running your own business, a more of a lifestyle business. There's very different philosophical, impacts on which route you choose. So that's an important consideration as well.
Mm-hmm. Actually, that's actually very sound advice as well, right? If you have the ability, like, you need to know, this is a matter of I think very strategic choice of whether to go.
Well, it's also, I think one of the things that we talked about previously is like the pitfalls on tech venture journey is like, that's one of the biggest pitfalls. Like, you have to understand, if you're going to raise capital from outside investors who have this level of expectation, that you're starting along this journey. And I think the most important thing, repeat founders have experienced this when they've raised money in the past, but who you pick to be on your cap table as an investor, who you choose to be your board member, these are very, very important decisions. You're spending a lot of time with these people over the course of building your business. And you should be doing your own diligence around who you want around the table. And that goes back to the idea of capital is nice. Like, the capital is out there, but really you want to find and have a good balance of how people are going to add value and how they share your values in terms of building a business.
Yeah, absolutely.
Yeah, we say that the average relationship between a VC and founder is longer than the average marriage. So you really got to pick your partners well, if you're going to deal with them for a long time.
That's excellent. That's excellent too. We had a couple of questions from the audience. I'd just like to sort of pass them along. One comment says that, would you say that the problem that we have is the lack of ambition in entrepreneurs in Canada, or lack of ambition adoption by the enterprises in Canada? Any reflections on that? And I do want to talk a little bit about enterprises in Canada too. Like, what can we do as industry leaders, champions, to help our ecosystem? But any sort of reflection on this particular question about perceived lack of ambition?
I'm happy to start. I don't think there's a lack of ambition. I think that the Canadian founders have, as much desire to grow big businesses as anywhere else in the world. I think that there are, two things that lead to us having, potentially smaller outcomes. And those are, first of all, sometimes they may be too focused on the Canadian market, so not enough of that global mindset. So it's not a lack of ambition. It's just it's kind of a understanding of what the largest outcome could be.
Okay. Yeah.
And the other is access to capital. And so, I think the more that Canadian founders get the capital they need to grow the business and the support of VCs who are going to push them to have those supersized outcomes, that the challenges can be resolved. I think there was a second part to your question, Dalibor, but maybe you can refresh me, or John can pick up.
Well, I think I could add just on the point, like, when you get to a certain stage of your business, and again, I agree with Jay's point, like, I think the ambition is how do you get to the next stage, and how do you bring in the right people? They could be, Canadians, we live in a world where there's hybrid workforces too. You can bring in people with a very deep expertise in specific sectors from anywhere in the world now. Like, bringing those people into your organization to help you get to that next phase of success, of growth. Because the reality is, in specific industries in Canada, no one might have done that in the past, right? Like, and there's talent out there that can help get you there, and we should be open-minded and ready to evolve and build the business to be successful at these different stages, which require different skills and different management techniques and so on.
Excellent, excellent. The second part of my question was, what can we do collectively as Canadian technology leaders, industry champions, people who run technologies within their organizations and hold the purses to budgets? What could we do differently and better to help actually leverage and grow our Canadian tech ecosystem?
Yeah,
now,
so
obviously, like we as Deloitte are doing this, right? But what else can be done and should be done?
I think this is a great question, and I think when Jay and I talk on this subject, we're also coming from like the perspective of seeing great teammates at TELUS, great teammates at Deloitte, step in and add a lot of value to the portfolio companies that we work with, and even companies that we were tracking or prospecting with. And number one is get in the arena. Like, it is so empowering, rewarding, satisfying to contribute to an entrepreneurship ecosystem, which is like the backbone of our economy. Like last year, we had our first AGM with our portfolio companies, with funds, with members of the leadership team at Deloitte. And what stuck out from the feedback afterwards was, how impactful contributing to the journey of these entrepreneurs can be. Like opening a door, providing timely or like deep-rooted feedback and advice can make a significant impact on their business at this point in time. And, as a Deloitte team member, as a team member of any large organization, you might be working on large projects that have large impact, but sometimes it can be difficult to really trace your contribution to a specific outcome. Yeah. When you're working with these types of companies, you can see what you're delivering, like what you're supporting. And I think it's fantastic. And I think more people should do it, whether it's within your organization or within the ecosystem.
So how I'm translating this, if you represent a major Canadian enterprise that has the ability to help grow Canadian tech ecosystem, consider having a venture arm like we do, right? That will be helpful. I just of course learned that you guys came and did this for TELUS, and TELUS has clearly a similar concept. So more of this would be an answer by large Canadian companies that feel that they can benefit and can help Canadian companies grow. The second component of that would probably be more Canadian companies buying Canadian tech solutions, right? Being directly, having the courage to say, I will be customer number 2 or customer number 3.
Yeah, right? I'd say, like, I think kind of what you're getting at is like, look, Canadian companies and large enterprises in particular should be very deliberate about how they think about innovation, because in Canada we tend to have highly concentrated markets with oligopoly like competition, which means that innovation can be stagnant. And the reality is technology is going to let new entrants come into the market faster. It's going to allow global competitors to take market share away. So there's all sorts of reasons why technology is going to make it harder for oligopolies to keep keep from innovating. So if you're deliberate about innovation and you're really making that a cornerstone of your corporate strategy, you may decide that having a corporate venture group makes sense for you. That may not. There may be other things you can do. You may have a partner program where you seek out startups to collaborate with in product development or in taking their products to your customers. There's a variety of ways that you can approach innovation. I think that's really the key.
That's a beautiful angle. That's a beautiful angle. You're right. Like most of our largest industries actually operate as oligopolies. So this is a brilliant. That's actually a new angle. I didn't think of that before. So thank you for bringing that up, Jay. Another interesting question, given this particular conversation, is your outlook on the place of incubators and accelerators that we know exist across the country. What do you think about their part of the ecosystem?
So first of all, I think the number of accelerators and incubators that are available to Canadians has gone up by an unbelievable amount in the last 5-10 years. There's now, no matter the type of company, what sector you're focused in, which geography you're in. There's probably multiple incubators that would be, relevant for you. So that's great. In terms of their benefits, like I think because there are so many, and there are now, like I often will see or meet founders who are participating in more than one at the same time, because that's often a thing you can do, is you just have to be intentional and understand what you're doing. So, some incubators, accelerator programs take equity in your company. So that means dilution for you as a founder. So if you're going to give up dilution, you better be confident that you're going to get value to make up for that. So talk to other founders that have been through it, talk to people that are involved with the program, and ask yourself if these are the types of people that you want to be working with. And for even the ones that don't take equity, is it worth your time? You're going to have to probably focus energy that could be spent doing other things, prepping the materials, meeting in person or meeting virtually, going through all the programming that's part of that particular accelerator or incubator. And again, what have other people that have been through that program, had as a result, and is it worth your time? So I think you just need to be very deliberate. And then, I think there was that might have been a related question that I saw in the chat, but there's a question around: are these good deal flow opportunities for Deloitte Ventures? The answer to that is typically like the companies that come out of those programs will still be a little bit early for Deloitte. So often, like the incubator and accelerator programs, a successful outcome is to raise like a pre-seed or seed round. So that's like the ones that succeed that have that happen. And because we're a Series A or Series B investor, it means they're probably, sort of 1 degree of separation away from being ready for us. But we have relationships with many of those programs across the country, and they'll let us know if they think that there's one that's sort of in our orbit of interest. And, like I mentioned in the OneVest story, like we want to know companies and founders, years before they're ready for us, so that when they are ready for us, they already know who we are.
Those are important messages. These are such important messages for people to actually hear, because there are preconceived ideas on how to prepare and how to go for the access to capital and so forth. I think that what you are painting is a picture of very, very open, relationship-based, frequent communication, collaboration-based approach to ultimately select companies that we will invest in, and then helping them grow. That it's really wonderful to hear. Thank you for what you do. We have one more question that I would like to ask. Obviously, this conversation triggered some interests from students in the audience as well. So we have a student who is asking, how does a student break into Deloitte venture capital business? What happens if somebody wants to do what you guys do, wants to join your team, maybe do not have VC background? Any perspectives there?
Well, I'd say if you're a student, I'd be super impressed if you had a VC background already. So if you're already doing something with VC and you're in university or college, a ton of kudos to you. I want to know who you are. Please reach out. And similarly, like we've had students support us. We've had internships with our team throughout the course of Jay and I being here. And I think one of the things we're looking for is just like the intuition and the excitement, like demonstrated through like being up to date and involved in the ecosystem. Like it's really difficult to get hands-on experience in entrepreneurship or ventures when you're like, you're in post-secondary education. There's some people that, have done startups and have sold things and built businesses along the way, which is super impressive. But, one of the things that, you can do is demonstrate an interest, like go do ecosystem events locally. In Toronto, we have a great one called TechTO, which has been going on for years, which brings people in the tech ecosystem together. Be up to date on some of the like interesting transactions or companies that are coming out of our ecosystem, and have a point of view as to like why you think they are being successful. And going into that next layer, demonstrating your interest. Like when we have conversations with people around that, we get super excited because that's what we're doing every day. And that's what we want to do with our team. Like I think, our team that we've put together here we're having these types of conversations all the time. It's what gets us out of bed in the morning. And we want people, you know, even if you're a student, to have that same mentality. We don't expect that they'll have the level of experience, but that excitement is something that's critical.
There we go. So thank you very much, John, and I think that was actually an excellent answer. I want to thank you very. We are at time. You managed to put a human face onto this sometimes concerning topic and worrying topic, and I love that. So thank you very much, Jay and John. For our audience members, we'll post the recording soon, and I'll send a link to this recording if you'd like to review it. Share it with your colleagues, and then please remember next Tuesday on March 26th, we are going to actually be talking about a very, very important topic. We'll talk about the value of digital transformation. We came up with the first very pragmatic framework, or what are the right KPIs to help us articulate digital transformation. I'll be joined by our global team, global leaders who will share that with us. So please plan to join us back. And with that, John and Jay, thank you so very much, and have yourself a lovely Thursday.
Thanks, Dalibor. Thanks for having us.
Thanks for having us.
Bye-bye.
Cheers.